Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts and Chat for January 29th of 2023. Please see our disclaimer for important information. Well, certainly the big news of the past week was the GDP report, in which we saw fourth quarter 2022 economic growth equal about 2.9% on an annualized basis. You can see here in this chart how that compares with prior quarters. Consistent for the most part with the third quarter, but I would hazard that this is probably going to be the best number that we're going to see for a number of quarters. I do think we're going to have some slowdown here. The question is, does it turn back negative? I think there's some groundswell of opinion that that is going to happen. Obviously, there's a lot of speculation out there about the eventual recession that people are pricing in, that certainly the market's pricing in. We'll see a little bit later. Fixed income markets are pricing in rate reductions. The Federal Reserve is not necessarily talking about that yet. In fact, they're pretty adamant about wanting to control inflation. But anyway, as it relates to economic growth and the pace of what we're going to see in the first half, I think it's going to be somewhat lackluster. Again, this is a pretty decent number, around 2.93%. Internals are pretty important. We're going to take a look at that here in just a second and kind of give you a sense of what were the drivers behind this and maybe what to expect going forward. Well, looking at the internal drivers of real GDP for the fourth quarter, you can see here that housing was a net drag, and we're kind of certainly going to drill down on housing in a second, but inventories were up, and that's always positive. When you think about the equation for what GDP is, I always remember it like this. It's like C plus I plus G plus X, and that's consumption plus investment plus government spending plus net trade is kind of how I think about the sum of the parts for what economic growth is. And so you can see your inventories is clearly an investment. Consumer spending really strong here. We're going to talk about consumer spending, savings levels, drawdowns, what to expect there, kind of some things as we sit here at the beginning of the year, kind of some very interesting dynamics going on in consumer spending. But inventories were up, and you tend to see wide swings with inventories from time to time. And so this is something, especially in a slowing spending environment, that you certainly wouldn't expect to continue for the next couple of quarters. In fact, inventories may wind up being negative by the time we get to the second quarter data. But government spending, trade, both contributors of about 0.5 percentage point to overall economic growth. As we look at real GDP versus the trend line, if you go back to January 2020 before the pandemic, and at some point we're going to kind of cease with these pre-pandemic comparisons because it's going to be enough time after the pandemic that we're just going to start establishing new baselines. But for the time being, we'll still use the pre-pandemic baseline here, and you can see where we're tracking to that. We are falling below, moving higher in terms of actual GDP. This is the actual real economy. So when you think about what's the size of the economy, well, the answer to that is roughly about $20.25 trillion right now. Now we're going to drill down here a little bit into consumer spending, very important contributor. And what's really interesting here, and we looked at that in that very first slide on the components of GDP, consumer spending has actually been very, very consistently positive. And you can see that here in the charts on the left, where we've got overall consumer spending contribution to GDP. And then on the bottom, we've got services, which, of course, we've seen some inflation in. So, when you have inflation in services, that tends to obviously depress consumption, depress demand for those services. But Oddly enough, it still remained positive. You can see if you pay real close attention where those bars, albeit positive, are becoming less positive. And I think this is the trend that we're watching right now. And it's kind of hard to see this, but in that lower left-hand side, you see kind of the bump in the second quarter, and then the third and the fourth were each lower than that second quarter. And I think that trend's going to continue. And this is the real barometer for the health of the economy, is what the consumer does. And you can see here, on the right-hand side, real final sales to private domestic purchasers. And this is, I think, perhaps a really good proxy for what we should expect. And you can see the real final sales here in that red bar in the lower right is clearly below the more recent trend lines. And I think this is the trend that's setting in right now. That obviously the Fed is paying attention to. I think investors are paying attention to. Granted, there are people out there that still don't think that we're going to have some kind of a recession. And obviously there are things that are out there, data points that are out there that would belie the existence or the near-term potential existence of a recession. But in any case, consumption here is important to watch, and we clearly see that kind of ebbing down a little bit, even though overall spending is still positive. Now here's housing contribution to growth. We know that that's been negative. We know what's going on in that market. Inventories, I told you already, that is kind of a unique development. You can see inventories on the right-hand side. Really just want to underscore the fact I mentioned earlier about inventories can have wide swings, and with demand perhaps slowing, there's less of a need to replenish inventories. And so I would think that this number, after 2 quarters of being negative contributors to growth, and now being kind of this whipsaw of positive, that is going to become less important in the coming quarters. Job cuts. So we'll talk about the labor market here for a second. And again, interesting dynamics here. I've shown you the unemployment rate chart relative to the trend line and the pre-pandemic line, and it's just oddly weak in terms of unemployment claims, the new claims for unemployment insurance that we get on a weekly basis, and it's just oddly very, very low. Here you see challenger job cut announcements, and these tend to be with larger companies, and we've seen a lot, from GE to technology companies, less so on the energy side, but services and consumer goods. We're seeing job cuts all over the place, and you can see that number is beginning to perk up. So as strong as the labor market is, we do see cuts, but I will tell you that the labor market is still extremely tight. We're going to see this in the next chart about labor participation. And here's that participation rate. It is a very interesting chart to watch. You can see that it's been in somewhat of a secular decline. That's symptomatic of an aging economy to some extent. And you've got people that are leaving the workforce. And in the case of the pandemic, obviously we had a lot of people that got displaced and all of that. And some of them have come back, but not all of them. And not all of them are going to. And so we see this kind of this more systemic shift in participation. And so what that tells you is that in some sectors here, you don't have this slack of labor. I mean, you have an undersupply of labor, and I think that's going to keep wages high in some of the lower paid service sectors, wait staff, hospitality, those types of places. Those wages are going to remain higher than they were, and we've certainly seen a dramatic wage increase for that cohort relative to the higher income cohorts. But this is something I think will continue to play out, that participation will remain low for at least the foreseeable future. Let's talk about job openings. Again, more labor data here. And this is from the Bureau of Labor Statistics, broken out between large and small companies. And what's interesting here is, you look at the large companies, and the red line here had a bump post-pandemic. That number is rolling over. We saw that clearly at play in the Challenger job cut number. So large companies are shedding positions right now. You see that clearly in that data. You see it here. That red line is trending lower. And the blue line represents small companies, again, under 250 employees. And that accounts for the overwhelming majority of companies out there. And you can see that number is still pretty strong. And you look at the directionally, it's moving in a similar direction from the red line, but you can see the rate of acceleration during 2021 and the beginning of 2022. And so this is the thing that is insofar as labor is concerned, confounding the Fed. Because you don't have that slack that's building. Typically, when you have an economic downturn, you have layoffs, you have higher unemployment rate, and you have more people that are looking for jobs than there are jobs available, and that's not the case right now, particularly with small firms. And as you can see here, this is just more evidence of this. This is from the NFIB, the National Federation of Independent Business. This is a share. This is survey data, basically from NFIB. And what it tells you is that you've got a lot of small businesses that have open positions right now that they can't fill because of the tight labor market. And again, some of that has to do with what we saw in the labor participation rate being lower and people leaving the workforce. But fact of the matter is still out there. And again, this is not something that you see when you're on the edge of a recession. Change in employment. This is by sector. And so what this does is kind of gives you a plot of the change of employment in these sectors during the first half of last year versus the second half of last year. If you go all the way down to the bottom, food services and healthcare, pretty consistent. Both positive, both adding workers. Local government added a lot more jobs in the second half of the year than in the first half. And then conversely on manufacturing, which we know is in the process of slowing down. We've seen these diffusion surveys where that are under 50, and anything under 50 represents contraction. We see those surveys moving negative on manufacturing, and so not too surprisingly, job additions in the second half of the year were lower than the first half. And construction, pretty consistent. But if you get up to the top, you see temp help, warehousing, retail. You still see, in the second half, there was a lot of negative adjustments there, which is actually pretty interesting. This is an Indeed data point here. This is job postings on remote work, and you see that number trailing down. Again, job postings, job hirings. What I'm showing you kind of may sound like mixed data, but it's showing you that there are parts of the labor market that are in fact slowing down, especially with large company announcements. But you still see a lot of lack of labor slack at the small company sector. But at the same time, you see companies that are not posting for as many jobs, and some of that has to do with the fact that that there's a cost to that, and a lot of employers have kind of resigned themselves to the thinking that they're not going to be able to find workers in this environment. But the confluence of data is just kind of in this midst of churn right now, which again, as I've said, is something that would tend to always confound a central bank if they're trying to set monetary policy. Business applications for tax IDs. We saw a huge spike in LLC formation, new company formation, people working from home, creating home-based businesses in the wake of the pandemic. And also it had to do with in some respects to lifestyle changes on the part of workers that did not want to go back into the office and have that grind and have the 2-hour commute or whatever. So a lot of home-based businesses, filings for new tax IDs. That too is turning south. It's still at an elevated level. So obviously there's still growth in filings, but clearly softening up in the wake of everything else within the backdrop. So a relatively busy chart here, but I love these where you have the line of best fit and you've got essentially a line of regression here. And so this is a plot on the x-axis. The horizontal axis it's the gap currently witnessed within these sectors relative to their trend employment. So anything negative represents that there's a gap of employment to what you'd normally expect these folks to be, these areas to be hiring. And then on the y-axis, the vertical axis here, these are aggregate job gains on a 3-month moving average. And so, the key takeaway here is that you have a lot of, concentration here around the zero line on gap. So when you think about, retail, trade, manufacturing, they actually have too many employees, and that's why in some respects you see some of the job cuts coming in that area. Whereas local government and financial activities, state government, healthcare, leisure, and hospitality, there's a huge gap to trend employment right now. And you've seen, oddly enough, in leisure and hospitality, a lot of gains, but there's a lot of churn in that. So there's gains in unemployment, but the quit rates in these sectors are at least in leisure and hospitality, are pretty high. But clearly healthcare, which is one reason why we focused on that as kind of a sector allocation. There's a lot of reasons to like healthcare. Obviously, having a gap in employment to trend is one of those things that are attractive. And we'll talk about durable goods. That was another big item we got last week. So needless to say, the durable goods order was a blowout. It was well above expectations. With these durable goods numbers, you always have to look at the internals. And so when you look at what drove that number, and again, you see those data plots for each month kind of condensed here. And this is clearly an outlier. We didn't see this in this kind of level of growth since the bust out after the economy reopened during the pandemic. But what happened was we had a huge surge in aircraft orders, in particular Boeing. And so these things are really, really lumpy. And if you back that out and you say non-defense X aircraft month over month, the number was actually negative. And so here we see durable goods orders slowing in this environment. And again, despite the labor strength that we see in pockets, although offset by job cut announcements and lower job postings, we have now a manufacturing area that's slowing. We have durable goods orders that when you back out this lumpiness of aircraft orders, they're slowing too. So it's painting kind of a broader picture here. And we look at this number maybe a different way. And so you've got the capital goods order number, non-defense X aircraft, that's in the black line. You do see that rolling over. So it's been a relatively high number, but it's peaked and it's rolling over. If you translate that and then you deflate that number by private capital equipment, a PPI, and you look at it from more of a real order standpoint, that is clearly negative here. We got some interesting charts that came out of some research pieces. I believe JP Morgan and Michael Cymbalist, who I happen to think is an extremely brilliant analyst. But these observations are a little bit more secular here on these next several charts, but nonetheless interesting. Here you've got inflation-adjusted federal debt per capita moving a lot higher. This is to this argument that we're leaving our children and grandchildren a huge debt to repay. And so what are the secular longer-term implications of this? And again, this is not a call on the next 2-3 months, but this is just kind of looking at it over a longer term, that this is something clearly we're going to have to reckon with, and the ability to alter discretionary spending. Again, I kind of bring this up in light of this debt ceiling issue that's kind of come to the fore over the last couple of weeks, and whatnot. And so, obviously something as we talk about how to resolve the current issue, we're going to have to like always have in the back of our mind the fact that we've seen a pretty strong move in this metric here. Well, and to my point about being able to leverage changes in discretionary spending, you see that in the amber line here, and that's clearly moving lower. So there's less tools in the toolkit, so to speak, because we've seen a fairly strong and dramatic increase in entitlement spending. Social Security, Medicare. There's calls from kind of a more radical faction of Congress to want to make changes in Social Security, as in like the benefit eligibility age, and so on and so forth. I mean, that really is the third rail, and it would be extremely, I think, politically suicidal to over the long haul to make those kinds of arguments. And even, when Paul Ryan was House Majority Chair and proposed what I thought were probably some constructive, very modest adjustments to Social Security, he was he was absolutely hammered. So I don't see that happening anytime soon. But clearly here, there's less levers to pull to manage federal budgets from discretionary spending. Government net interest payments is something that I've been thinking a lot about with the increase in interest rates. So you see our as a percent of GDP, this is not the average rate paid on debt, which is actually still extremely low, but interest payments as a percent of GDP are obviously going to go up because we've got higher interest rates. Now, it's not anything that we should be I think like looking at the mirror and thinking about Armageddon, but this is another budgetary issue when you get another 10 to 15 years down the road. Is something that we're definitely going to be talking about. Now, here is the money supply. I've talked a lot about the rate of change of money supply and how often this is overlooked in the whole inflation discussion. People talk about interest rates and how that's going to curb demand, and that's a valid conversation. But at the root of all of this is the supply of money. The whole the empirical definition of inflation is too much money chasing too few goods. And so when you take that punch bowl away, you take the supply of money and move it down. And in this case, it's been negative. And we haven't seen this level of money supply withdrawal from the economy in a long, 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 long time. This is going to help us in our inflation fight. Even though it works at a bit of a lag, it is working right now, I think, and will continue to work. And this is, I think, money supply may not get all the press that it's deserved, but it will be the answer to the inflation problem long term. And we'll look at here at the Treasury market, and then we'll look at the equity market. I've got a couple slides here, and so we've seen the 2-year Treasury yield move back below the federal funds target. And you see here on the spread at the bottom where that's turned negative to the tune of about 27 basis points. Interesting dynamic. So, right, the Fed is out there saying we're going to keep interest rates high, we're going to fight inflation, we're going to be steadfast, yada, yada, yada. Market is now pricing in 50, 60 basis points of interest rate reduction by the end of the year, like at the end of the year. And, that's growing inconsistency with what the Fed is saying. And so, and that's being borne out here in the fixed income market, which I will always say does a better job of kind of forecasting or foreshadowing, the eventual how things eventually play out than does the equity market. And so, clearly, this market is expecting interest rates to roll over because of the slowing economy. Now, on the equity side, from Bloomberg, kind of an interesting deal here. We've got in this kind of brownish line, we've got the Conference Board the index of leading economic indicators, subtracted or subtracting from that the coincident indicators. And so it's basically an index spread. And then they overlay that here with this black line, which represents the S&P 500 year over year return. And I've never seen this chart before, but it has a lot of very interesting explanatory power to it. I mean, a pretty decent correlation, not super high. I'd say if I had to guess, it's probably about, zero point 0.6, but 0.65 maybe, but it is definitely a positive correlation. And so what this is telling us is that the leading data typically underperforms, as it says here, coincident data before a recession, and that you typically need to have that play out like it is before you can get the equity markets to begin to rally. And you see the shaded areas here represent recessions, and so that is pretty consistent. So again, if we feel like we're close to a recession, then this chart makes a whole lot of sense, and it should get you a little bit more excited about the opportunities in the equity market, not necessarily tomorrow or the end of February, but later on this year for sure. Interesting chart here from Deutsche Bank. This is a question on whether respondents think that China's reopening will be inflationary. We've been talking about this for a little bit. We've been talking about the Chinese reopening, and it's this need to get the economy open. And what does that do? Well, obviously it creates more demand for industrial materials, creates more demand for stuff, more spending for stuff coming out of China. And so the thought is that spending, that activity will be inflationary. Well, as it turns out, the majority of respondents are actually in favor that this will help to stoke inflation. I think the people at the far end of this theory think that it's going to completely confound the Fed, and that we're going to basically go back to inflation levels that we saw earlier last year. I don't think that's going to be the case. In fact, it's interesting to note here that there are a reasonable percentage of respondents that actually think that this is going to be disinflationary. So again, there are some strong opinions on this. Not everybody is in consensus, which I think is a good thing. And I think the people that fear that China is going to really blow out inflation, I just don't agree with that. Here's mortgage industry look, mortgage applications. This is the MBA purchase index. You see that little blue line there for 2023, how we compare with prior years. Not surprising, very weak. Right-hand side is our mortgage rate. Excuse me. And, we're down a couple basis points, about 6.2%. You can see we're off our peak of over 7, which happened last fall, heading into the beginning stages of the fourth quarter of last year. But clearly mortgage rates coming down are nice, but we do see a lot of I think builders and other financing firms kind of taking matters into their own hands. You see builders that are actually buying down rates to try to get people in homes. We see new home activity pick up, and conversely, we see existing home sales, which we've talked about over the last couple of months, really kind of nosedive. And a lot of that has to do with housing affordability, has to do with these mortgage rates being high, but seeing people be creative. And I actually was talking to somebody that has observed some relaxation in the rules for Fannie and Freddie regarding where you can get your down payment from. I mean, typically it's like friends and immediate family, or something of that ilk, and they've relaxed that now. And I hear stories now of people setting up GoFundMe pages to try to help afford higher down payments. So interesting reactions here coming out of the housing sector. We've got global geopolitical risks. This is a BKA chart. Question: Beginning to percolate now regarding Europe. I listened to Peter Zion, and he's not terribly constructive, like geopolitically, thinking that the Russians are going to wait for the spring, make an offensive. Obviously, that's important because of the timing of sending Ukraine all these tanks that we're talking about from Germany and the U.S. But these tensions are going to rise, and Russia may target agricultural infrastructure, which, if you do that and all of the dependency in the third world on grain shipments coming out of the Ukrainian breadbasket could put a real choke point on things. And remember, that when that last happened, and food supplies to the Middle East and to some of these third world Arab countries, it really promoted the Arab Spring and caused a lot of disruption. So anyway, Peter Zion and here BCA is kind of like foreshadowing potentially an increase in geopolitical risk. And not too surprisingly, as I pulled this chart off of Visual Capitalist, and this is actually from the World Economic Forum Global Risks Report, which I've skimmed, but I've not read in detail. And I just love this stuff because, it's a lot of smart people that put this together. And so basically, as you go from, the lower left to the upper right, you get in increasing, concentration of people that think that this is important. And also, well, let me back up. Moving from left to right and up, from lower to upper, there's more conviction and a feeling that these things in the upper right are going to have more of an impact. Hopefully that makes sense. Energy supply crisis has been up there for quite some time, for a lot of obvious reasons. LNG, Europe has been extremely warm this winter, so that really hasn't been a problem. In fact, European economic growth has been better than the U.S. in many respects. A cost of living crisis because of inflation, rising inflation. You can see that. Food supply crisis I mentioned in that last slide. And then you get into cyber attacks and so on and so forth. But we'll see how this all plays out. But this is basically a summary of the feeling of a lot of fairly smart, intuitive people. Now we'll talk about income as we kind of finish out this. Different drivers of excess savings between the various income cohorts and quartiles. So again, this is more, as much of anything, a recap. So the bottom quartile, the poorest Americans, got a lot of fiscal support. These are checks during the pandemic, so on and so forth. We know that. Second quartile, same deal. Top quartile, while they did get fiscal support, most of their contributions to excess savings have been from reductions in outlays. I mean, these are people that are just saying, listen, I don't need this expensive car, and they're doing better at rationalizing their savings, whereas people at the bottom end are stuck with the fact that things cost more, and so it's actually a headwind for the bottom half of the economy. So again, this is just kind of a recap of what's going on, but it's clearly important to show that different income groups are seeing this from a different perspective. A little bit busy here, but it all relates to consumer savings and consumption and where this is all going to go. We know that excess savings has been high, but we know that there's been a pretty dramatic drawdown. So the left-hand side is kind of like, what does that all look like? The drawdown in excess savings. Some fear, the kind of those that with a little bit more of a negative outlook, are saying that that this drawdown in excess savings is going to come to a head the middle part of this year to the third quarter, and you can see, an extrapolation to clearly the top quartile. I mean, they're drawing down, and they had in the top quartile, the upper income people are probably the smartest in terms of hoarding the money, but they're also huge spenders in the aggregate too. And so anytime, a lot of your spending from that cohort drops, then it has an impact on the whole. And that's clearly what's in evidence here. But overall, at least in this particular analysis, which is data from the Fed, data from the Bureau of Economic and Analysis, but it's a research report essentially from Morgan Stanley, says that, by and large, that overall drawdown is expected to slow this year. And so if that does become the case, I think it probably tells you a couple things. One, that people are acknowledging the slowing economic environment and probably making conscious decisions to slow spending in that environment. And obviously it probably comes too from a recognition that the excess savings don't last forever if you keep spending them. But right-hand side, checkable deposits, as we sit here today, consumer overall is in pretty good shape. Again, and a lot of this has to do with the upper quartile, and you see down below on consumption, what's happening on consumption, which has been strong, but we expect it to slow. And what this chart tells you in that area that's circled on this BCA research piece is that lowest income cohort is, they're clearly seeing a pinch in their ability to get things paid, a pinch in consumption, a pinch in resources, and so consumption is lower. And so again, this will be a tale of kind of two cities, so to speak. You'll have the lower income areas that are really going to be pinched in this environment, and then you upper income cohorts that are going to acknowledge, slow their spending, and kind of both contribute into the slowdown that we are in the midst of. Here we go with liquid assets. Again, to this whole notion of the upper income cohorts are doing a better job of managing liquidity, managing consumption, or managing, perhaps savings. And then you see liquid assets per household are actually up significantly. A lot of this has to do with housing values. Or excuse me, this is liquid assets, so it doesn't have to do with housing. So check that. This has to do with fungible dollars, checkable deposits, things like that. Household debt service ratio, we talked a lot about that after the pandemic, where the household balance sheets really got cleaned up, but now we see people increasing their charge card balances. We don't really see a wave of defaults or credit issues yet with that. But we do see an increase in credit overall. So household debt service ratios are moving a little bit higher. And we know people that are taking on new mortgages obviously are paying higher mortgage rates, so that's contributing to this as well. But on the lower right-hand side, we've got household income growth expectations. This is actually from a New York Fed survey, and those are moving higher too. So this right here in the lower right is certainly something you wouldn't expect to see heading into a recession. But it's an interesting dynamic that I think maybe helps to offset perhaps some of the drawdown in excess savings if you're having income that's continuing to grow. And again, at the service sector, we said those wages are moving a lot higher than those with white collar jobs. But if you're having an overall increase in income, even though your lower income folks are having to pay more, inflation's high, so they're getting pinched there, this income growth helps to dampen this overall impact. And again, if you're expecting, things to erode materially to the point where you enter this recession, you just don't see this like this. And this kind of gives a little credence to this notion that, if we do have a recession, then it's got to be pretty shallow. Total spending plan. So if you look ahead, again, this is very consistent with what I feel like I've been saying is that we're expecting a slowdown. So total spending plans. This is for that upper income cohort. So this is kind of showing some of the data we were looking at a couple slides ago in a different light, but you can clearly see both overall spending and non-essential spending expectations are moving lower for 2023. And then you see here on the right-hand side, which is a survey of 2,200 adults from, I believe this is Morning Consult that put this together. And so you clearly have more people that are witnessing higher expenses, which in an inflationary environment, absolutely no surprise. That's all we got this week. Hope you've enjoyed the chart pack. A lot of interesting data in this week. So if you have any questions, please feel free to reach out. Hope you have a wonderful week, and we'll talk to you again soon.